Welcome to this Iron Financial Explainer. I'm the lead analyst, and look, my mission here is incredibly simple. I want to help you forge a much stronger portfolio and cut right through the relentless market weakness we're seeing out there. Today, we are bringing out the heavy machinery. Think about it. Alibaba used to be the absolute, undisputed titan of the East. It was this rock-solid foundational asset in literally any serious global tech portfolio. But today, it's a complete battleground stock, just surrounded by doubt. So we are running a full-scale structural stress test on Alibaba Group's Q4 and full fiscal year 2026 earnings. We're going to find out what is actually happening beneath the surface.
And I'm the Market Skeptic. I represent you, the audience. My job is to look right past those perfectly polished corporate blueprints, cut through all the management spin, and find the actual cracks in the concrete. Because right now, the numbers coming out of Hangzhou are raising some massive, waving red flags. And if you're thinking about putting your hard-earned capital to work here, we need to know exactly what we're buying into.
To truly understand Alibaba right now, you really have to look at it as a massive ongoing construction site. They are right in the middle of a colossal structural overhaul. The question we're drilling into today is this. Is Alibaba laying indestructible steel beams for a dominant AI-driven future, or is their foundational core simply sinking under the crushing massive weight of their own artificial intelligence costs?
Exactly. Because let's just be fiercely honest for a second here. When a management team comes out and tells you they're going through a rebuilding phase, a lot of the time that just means they're actively destroying shareholder value and burning through your cash. We really need to cut through all that noise, completely ignore the executive promises for a minute, and figure out if this new foundation can actually hold real weight.
So here's the multi-billion-dollar question we're answering in this explainer. Is this incredibly painful transition period actually creating real long-term structural strength for Alibaba? Or is all this grand talk about a revolutionary AI ecosystem just vaporware? Is it purposely designed to hide a massive, inescapable value trap? Because there are literally billions of dollars in retail capital trapped in this ticker right now, just sitting there, waiting for a turnaround. Let's get into the drill down and find out if that turnaround is actually coming. Lead, show me the top-line foundation. All right, let's look at the bedrock. For fiscal year 2026, Alibaba's total revenue hit a staggering 1,023.6 billion RMB. To put that into perspective, that is over 148 billion US dollars. Massive scale, right? But here is the catch, and it's a big one. That top-line number represents merely a 3% year-over-year growth. Now, to be fair, if you strip out the disposed businesses like Sun Art and InTime, revenue on a like-for-like basis actually grew 11%.
Look, I really don't care how you dress it up with adjustments or like-for-like exclusions. A headline 3% growth rate for a company that used to absolutely command the entire Chinese consumer market, that is terrifying. In the tech world, 3% growth is synonymous with a mature, slow-moving utility company, not a hyper-growth tech giant. It is completely flatlining. A foundation that isn't expanding is highly vulnerable to erosion. And honestly, the pain gets significantly worse when you look below that top line.
You aren't wrong there. Let's examine the structural load. While revenue managed that tiny 3% crawl, income from operations completely collapsed. We're talking a 64% drop down to 50.1 billion RMB. Furthermore, adjusted EBITA, which, gives us a much clearer picture of core operating profitability, plummeted an incredible 56% down to 76.4 billion RMB.
Stop right there. How on earth does a company grow its revenue by 3%, yet see its operating income implode by 64%? That tells me their cost of doing business has skyrocketed completely out of control. They are spending significantly more capital just to stand perfectly still. We're talking astronomical marketing spend, massive compute costs, and heavy R&D just to keep the lights on. That is the exact definition of a rapidly deteriorating margin profile. And for a shareholder, it's brutal to watch.
The cracks in the armor become completely exposed when we isolate just the fourth quarter of 2026. Q4 revenue came in at 243.3 billion RMB, again keeping that same sluggish 3% pace. But the operations line, it's shocking. They posted a brutal Q4 operating loss of 848 million RMB. For context, in the exact same quarter last year, they drove an operating income of 28.4 billion RMB. Adjusted EBITA for Q4 took an 84% year-over-year nosedive to just 5.1 billion RMB. This is exactly what I'm talking about. Going from a massive 28 billion income to an actual operations loss in Q4, an 84% plunge in adjusted EBITA, the structural integrity isn't just failing here. The walls are entirely caving in. And here is the absolute starkest evidence of the bleeding. Management can engineer earnings all day. They can adjust EBITA to make things look prettier, but you absolutely cannot fake cash flow. Last year, in FY25, Alibaba generated a massive free cash flow inflow of 73.8 billion RMB. Fast forward to FY26, and that turned into a severe, painful outflow of 46.6 billion RMB. That is a negative swing of over 120 billion RMB in a single 12-month period. They are hemorrhaging real cash to fund this rebuild. Lead, you've got to justify this cash bleed to me right now. I will. The heavy lifting behind this massive cash burn is highly intentional and deeply strategic. Take this quote straight from CEO Eddie Wu. He says, Alibaba's full-stack AI investments have progressed from incubation to commercialization at scale. You see, the capital expenditure driving that massive free cash flow outflow is going directly into cloud infrastructure and training their massive Qwen large language model. Qwen requires immense physical computing power. We are talking thousands of cutting-edge GPUs and massive server farms. They aren't burning cash on bad inventory, they are buying the heavy machinery required to own the next decade of digital commerce. Commercialization at scale sounds incredibly great in a perfectly polished press release, but let's look at the actual cost of this AI construction site. The Taobao Analyst's report highlighted that Alibaba's All Others segment, which houses DingTalk and a whole lot of these new side initiatives, saw its Q4 EBIT loss widen massively to 20 billion RMB. That is up from a 9.8 billion loss just 1 quarter prior. And what drove it? Upgrading the Qwen app and pushing heavy Lunar New Year promotional incentives. The domestic competition against players like JD and PDD is so cutthroat right now that Alibaba is paying through the nose just to force users into their ecosystem. Look, you have to invest aggressively to change entrenched consumer behavior. Let's pivot to another major investment area making real structural gains, quick commerce. This segment is growing like a weed, up an impressive 47% to 78.5 billion RMB. However, as the earnings report notes, this massive growth required heavy user subsidy investments to roll out Taobao Instant Commerce. They are building out a hyperlocal logistics network designed to get products to your door in under an hour. That requires physical warehouses and intense upfront capital deployment.
Right. So this is just another segment where they are essentially buying top-line revenue growth with margin-crushing subsidies. The top line looks fantastic, sure, but the bottom line is footing the entire bill.
Fair point. But now let's transition to where the foundation is legitimately solid steel. Enter the Cloud Intelligence Group. If you hold BABA, this is the exact metric you need to watch. This is the bedrock of the new Alibaba. Q4 revenue for cloud hit 41.6 billion RMB, which is a 38% overall year-over-year increase. But the most crucial metric here is the 40% growth in external cloud revenue. External is the absolute keyword. It means outside enterprises are actively voting with their wallets, choosing Alibaba's infrastructure over competitors to run their businesses. Okay, I have to concede this point. The cloud metrics do show real structural integrity. When you break down that external cloud revenue, 30% of it is being driven strictly by AI-related products. In a market where almost every tech company is claiming AI growth based on pure vaporware and buzzwords, Alibaba is actually converting its heavy capital expenditure into real enterprise sales. Companies are actually paying for this compute. It's real revenue, not just an internal R&D science project to show off to investors. Exactly. Let me really hammer home the true strength of this AI infrastructure. AI-related product revenue alone hit nearly 9 billion RMB, delivering its 11th consecutive quarter of triple-digit year-over-year growth. 11 straight quarters. As a seasoned trader, I can tell you that this level of consecutive explosive growth in a brand new tech vertical is incredibly rare, and it is heavily underpriced by the broader market right now. The enterprise demand for Alibaba's AI compute and model hosting is insatiable, and it looks highly durable. To validate this structural strength, I pulled the CNB International Earnings Summary to drill deep into the consensus estimates. The analysts over at CNB maintain a buy rating with a target price of $206.1 US. Think about the massive gap between current market sentiment and that target price. Why are they so bullish? Because they see the top-line resilience. They project revenue accelerating into FY27 and FY28, specifically citing that Cloud Intelligence Group growth is the defining driver of Alibaba's future share price. They are modeling the exact structural transition we are tracking today. That is fine for an FY28 spreadsheet, But let's talk about the genuine pain retail investors are eating right now in the real world. FY25 non-GAAP diluted earnings per share was 8.18 RMB. In FY26, that EPS completely cratered by 59%, down to 3.35 RMB. I don't care how beautiful the blueprint looks for 3 years from now, a 59% drop in EPS is absolute value destruction today. How are everyday investors supposed to stomach this kind of massive hit to their portfolio while management plays around with incredibly expensive AI models? They swallow it because this is the absolute cost of evolution. The EPS drop is the temporary cost of permanently embedding AI directly into their core e-commerce foundation. They're completely integrating Taobao and Tmall into the Quen app, turning it into a hyper-personalized shopping assistant. On the flip side, they are rolling out the Wukong AI for merchants. This AI literally automates merchant workflows, generating product listings, running customer service bots, and handling dynamic pricing, saving sellers thousands of hours. If Alibaba doesn't take the EPS hit right now to build these tools, they lose market share entirely to competitors who do. All right, let's look at the rest of the site layout. Compare the reinforced cloud segment against the Alibaba International Digital Commerce Unit. Yes, cloud saw its adjusted EBITDA grow an impressive 35% to 14.2 billion RMB. But the International Digital Commerce Unit, despite management aggressively claiming improved efficiency at Alibaba, still operates at a structural loss of 2 billion RMB for the year. International expansion was supposed to be Alibaba's big escape hatch from domestic economic stagnation. Instead, it is still an absolute money pit. It is a money pit right now, sure, but here is exactly why they can afford it and why they will survive this transition completely intact. Let me unveil the ultimate concrete base holding Alibaba up. As of March 31st, 2026, Alibaba sits on a massive war chest of over 520.8 billion RMB in cash and liquid investments. That is 75.5 billion US dollars. That kind of liquidity provides a management team with the ultimate luxury, time. It means they do not have to dilute shareholders to fund this AI pivot. They have the pure capital to execute a multi-year rebuild without ever worrying about insolvency. And despite the heavy capital expenditure, the terrifying free cash flow outflows, and the deep margin compression, management is actively reinforcing shareholder loyalty. The board just approved a solid $2.5 billion aggregate regular cash dividend. That works out to $1.05 per American depositary share. If you're an income investor, this regular payout provides a massive psychological safety net. They are literally paying you to wait while the concrete cures on their massive new AI infrastructure. Let's summarize the drill down. Here is the iron, the undeniable pillars holding up the bull thesis and proving Alibaba is actively reinforcing its technological might. Cloud external revenue isn't just growing, it's accelerating at 40%. AI products have surged by triple digits for an astonishing 11 straight quarters. They boast an indestructible 520.8 billion RMB cash pile, safeguarding the entire balance sheet. And newer ventures like quick commerce are surging at 47%. The structural strength here is incredibly real, and the pivot toward enterprise B2B tech is undeniably working. Right, but let's not ignore the rest. The cost of this structural strength is just staggering. You have a brutal free cash flow swing straight into a severe outflow of 46.6 billion RMB. Q4 adjusted EBITDA plunged a jaw-dropping 84%. Non-GAAP EPS has been utterly gutted by 59%. And honestly, the most concerning part is the massive opportunity cost. While your money is tied up in Alibaba's painful, cash-bleeding transition, other tech stocks with clean balance sheets are running hard. The current financial foundation of their core retail business is under immense, undeniable strain. It's time for the final verdict. Is Alibaba a premier portfolio addition or a dangerous value trap? In my view as lead analyst, the broader market is severely mispricing this transition. The temporary pain in e-commerce margins is completely masking the explosive, highly profitable growth happening inside their cloud and AI infrastructure. Backed by a $75.5 billion cash cushion, Alibaba is a fortress successfully rebuilding itself for the next decade. It is a long-term, high-conviction opportunity.
And as the market skeptic, I say proceed with extreme caution. The cloud growth is undeniably impressive, absolutely. But e-commerce is still the heavy engine that pays the bills. And right now that engine is burning oil incredibly fast. Until I see free cash flow turn decidedly positive again and margin compression actually stabilize, it just feels too much like a trap.
And that is the iron financial breakdown. We've shown you the heavy machinery, the solid steel, and the creeping rust. So what's it going to be? Are you willing to step onto a construction site that's bleeding cash today to own the ultimate AI infrastructure of tomorrow? Or is your capital safer watching from across the street? Let us know what you think. Until next time, stay focused, manage your risk, and keep forging ahead.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.